credit scoring. A lot of people don't understand credit scoring because they have the wrong approach in how they try to figure it out. Like they're looking at it the wrong way, and if you understand what the credit score, what the essence of the score is and what it's trying to predict, you'll usually be able to get to the right answer and be able to predict certain things as to whether or not something's going to help or hurt somebody based on knowing how the score is formulated. With that being said, what is the credit score? Well, a credit score is only trying to predict whether or not your borrower is going to go 90 days late over the next 2 years. That's all the score is trying to predict. There are other scores out there that, like a bankruptcy score, the auto industry options score that deals more with automobiles. There's several kinds of credit scores put out by Fair Isaac even, but Fair Isaac's classic FICO score that the mortgage industry uses, and that's the only credit score the mortgage industry does use. That credit score is from 300 to 850, and it's only trying to predict whether or not the borrower is going to go 90 days late in the next 2 years, not foreclosure, not anything else. Of course, if somebody's going to go 90 days late, they're probably more likely to go into foreclosure than somebody that's not going to be 90 days late, but it's not trying to predict that. It's just trying to predict 90-day lates in the next 2-year period. Now, how did they get the scores? Well, this is where it starts to really make sense. They took 1 million people from each, 1 million credit reports from Experian, 1 million from Equifax, 1 million from TransUnion. They followed those 1 million people over, well, actually, they didn't follow them. They just said, okay, here's the 1 million, and we're going to wait 2 years, and we're going to pull their credit again. And at the end of 2 years, they pulled those same 1 million people's credit reports for each bureau. So it's not the same people across the board. It's just a sample of 1 million here, a sample of 1 million here with Experian, and a sample for Equifax. Then at the end of 2 years, they said, okay, which ones paid 90 days late over the last 2 years? And they looked for 90-day late payments or more, and they got those people and separated them from the ones that didn't pay 90 days late. So let's assume for demonstration purposes that 200,000 people paid 90 days late, 1 out of 5. So for one of the bureaus, they got the 200,000, put them over here, the other 800,000, they left them over here, and then they said, okay, what did the people that paid 90 days late over here in this group of 200,000, what did they seem to have in common? And then what did the people that didn't pay 90 days late seem to have in common? So the 800,000 people, the traits they had in common, they gave values to that would increase your score, where the people that paid 90 days late over here, the 200,000, the things they had in common, they made very detrimental to your score, and they assigned values to those features. And that's where you get all the different things that make the credit score go up and down. So what do you think 200,000 people over here that paid late would have? Chances are they'd have maxed out credit cards, right? Okay, maxed out credit cards is a very high indicator that you're going to go 90 days late. Therefore, when your credit cards are maxed out, your credit score plummets. Chances are paying late, all 200,000 people, of course, had that in common because they were 90 days late. So paying late is the biggest factor in determining what the credit score is. Now, what are a few things that people that didn't pay 90 days late have in common? They probably had very low balances on their credit cards in relation to their limits. They probably paid their bills on time. They probably didn't apply for a lot of credit. So there's a lot of factors that are good, and you're able to start separating what makes the score go up and down when you understand how it was created. Now, of course, there's flaws, but there's ways to get around those flaws, and there's also ways to use those flaws to your benefit, and I'm going to go over that in a few minutes. Now, what are the odds of default? Well, here's Fair Isaac, as unfair as the credit score may seem, they ran these numbers over and over, and they're pretty dead-on accurate. And even though some people sort of fall victim to the credit scoring system, overall, it's a pretty good system. It lets business happen a lot faster. You don't have an underwriter that has to sit there with the loan approval application, whether or not it's going to get approved on their desk for 2 weeks until they get to it. It makes business happen a lot faster, and it makes you guys able to do more business because there's less human involvement in the approval process, and you can flow a lot faster. And here's what the numbers Fair Isaac tracked were. If somebody had above an 800 credit score, for every 1,292 people that had an 800 or above on the credit score, only one of them went 90 days late in a 2-year period. Now, look what it is for 700 to 719, 1 out of 123, and then 720 to 759 is 1 out of 323. Now, of course, it would make sense to give somebody with an 800 credit score a better rate than a 720 because they are less likely to go 90 days late. But at that point, there's not enough people to have an 800 for the banks to even worry about splitting hairs that much. So that's why 720 seems to be the magic number that people want to have. to get the highest rates because that's where banks usually make their best products cut off at. Now, look at the subprime rates. 500 to 600, 1 out of 8 people are going to pay 90 days late in the next 2 years if they have that range. So when Countrywide gives a subprime loan to 8 people within that range, they know that they're going to have to chase one of them for the money. So the other 7 have to make up for the fact that they're going to have cost involved. Doesn't mean they're going to have to go after a foreclosure. It just means they're at least going to go 90 days late. Maybe 1 out of the 8, maybe 25% of those actually go into foreclosure, maybe half, I don't know. But I'm sure they figure the numbers out beyond that as how it pertains to them. Now, below 500, forget it. Maybe 1 out of 1. You better get a loan off your mom or something. I don't think you're going to get anywhere else. Now, so what are the determining factors of the credit score? Pretty simple, folks. I'm sure you guys know basically these right here. Past delinquencies, biggest factor, 35%. Revolving debt ratios is 30%. A lot of people think it's credit card balances. It's not. Okay? I've had $140,000 owed on credit cards when I was investing in my software, and my credit score was still a 740. Why? Because I had $450,000 of available credit card limits. It's not the balances, it's your ratios. So the higher your limits are, the better. So don't let people tell you, oh, you can't have too much credit because the creditors don't like it. Well, maybe certain creditors don't like it, but the credit score loves it when your ratio is low. It doesn't care how much you owe. Because if you think about it, if somebody owes $100,000 in credit card debt, that might seem like a lot, but the score is trying to predict over the next 2 years whether they're going to go 90 days late. If you have $400,000 in limits and you only owe $100,000, chances are you'll be able to pull from your credit cards for the next 2 years and prevent yourself from going 90 days late. Therefore, statistically, that didn't translate to you being 90 days late or more. That's why the score comes up that way. Now, the average age of the credit file, it's 15%. And I'm going to go through these individually, so you don't got to worry about writing this down. It's the older the better. Don't close credit cards. It's the worst thing you can do. One thing I've seen all 800-plus credit scores have in common are they all have very high limits, very low balances, and very old credit cards. You got a 35-year-old Sears card, a 30-year-old Citibank, and they don't have hardly any inquiries, and they're just very conservative. That's the equation to having above an 800 credit score, which is overkill. All you need 720. Mix of credit, 10% of the credit score, a healthy mix. 3 to 5 revolving credit cards, but having more is not going to hurt you hardly at all. So don't close credit cards to get down to that number. You'll hurt yourself definitely. But if you're starting off, I wouldn't even suggest stopping at 3 to 5 because having more is not going to hurt you that bad. It might be a few points difference. But it also likes to see you have 1 auto and 1 mortgage loan to have a healthy mix, like 3 to 5 credit cards, 1 auto, 1 mortgage. Inquiries. How many times did this person actively pursue credit and money from some entity? That is what hurts the credit score, not whenever they get promotional inquiries or check their credit online, anything like that. Only when they're actively pursuing credit does that inquiry hurt, and that's 10% of the credit score. Now let's go into past delinquencies, 35% of the credit score. Timing of the delinquency is important. One good thing about the credit score is time does heal. A 30-day late from today is going to hurt a lot more than a 30-day late from 3 years ago. Okay, because statistically, whenever you've behaved yourself for a while, you're less likely to go 90 days late in the next 2 years. It all comes back to that. That's all it's trying to predict. The level of delinquency, of course, a 60-day late is worse than 30, 90 is worse than that, charge-off is worse than that, foreclosure and repossession are worse than charge-off, and then worst of all are the bankruptcies. Bankruptcies hurt the most, but like Ron was saying before about bankruptcies, sometimes it is a very good tool to use. Because if you have a borrower that has $80,000 in charge-offs and they can't pay anything, and collection agency sells it to this collection agency, this and this, moves on, they get sued a few times, judgment gets entered, it's like they're constantly being punched down and they can't get out of the gutter. But if they do the bankruptcy, they're already 480 crappy score, might go down to a 450, but at least from that point they can go up because they're not going to have collections and everything getting peppered every few months, changing from creditor to creditor. So sometimes it is the right answer if they can't afford to get out of debt. Now, the last activity date, very important, folks. Fair Isaac and the credit bureaus would like to say this was fixed, but it's not. If you have a collection and the date of last activity is from 4 years ago, and you tell the borrower, yeah, you should pay that collection because the lender's requiring it because you're doing a cash out, whatever it is. A lot of the times, not all the time, that's why people get confused because sometimes it hurts, sometimes it helps, they're not sure. whenever they pay the collection agency updates paid to the credit bureau, but sometimes they change the date of last activity from 4 years ago to today. Now, the credit score, unfortunately, does not have a memory. It doesn't know that this is the same collection that had the date of last activity from 4 years ago yesterday. So it's looking and it says, well, I see recent collection activity. I'm going to ding them 20 points there. I see that it's a paid collection, so I'm going to add 2 points than if it was unpaid. So you help yourself a little bit by paying it, but you hurt yourself 5 times more with the date of last activity becoming current. So never, ever pay collections or charge-offs or tell your borrowers to right before closing. It's suicide. You run the risk of the score tanking. Past due notice has destroyed credit score. How many people here have a mortgage that's due on the 15th, and it says your payment is X on the 15th, but if paid after the 27th, it's X plus whatever. So the penalty starts at the 27th. How many people here habitually pay after the 15th, but before the 27th in that scenario? Anybody? I do. Don't feel bad. Okay, well, the thing you got to watch out for is if you do that, you're considered past due on the 16th. You're not 30 days late, but a lot of the creditors now, the things they're doing is they're actually reporting to the credit bureau on the 16th, boom, past due $4,200. And if you pay the bill before the 27th or even before 30 days beyond that point, you're not going to get the 30-day late payment, but the past due balance showing, even with 0 late payments, is still a bad event for the credit score. So whenever your borrowers, it's coming up to crunch time, make sure they know to pay all of their bills before the due date. Otherwise, they run the risk of you pull the credit, everything's okay, they do the mortgage thing, a week later, the day before your lender pulls the backup report, it ends up going and getting put on their credit report. Their score, when the backup report's pulled, is 10 points lower. All of a sudden, the loan doesn't go through, all because they were past due. So it's but if you're not getting an auto or a mortgage loan or anything, it doesn't matter. If it's going to be on there, as long as it's not going to be a 30-day late, it will go away. So it's like take the advice in stride. Sometimes it doesn't matter, but if you're getting a loan, it does. Missed payments. Credit score actually treats high payments being missed as more of a negative event than if somebody missed a low payment. Reason why? Statistically, if you missed a high payment, you probably didn't have the money. Where if you missed a low payment, some people in this $800,000 positive side that didn't go 90 days late, a lot of them may have missed smaller payments. Maybe it got lost in the mail, whatever. There is a tiny little bit of separation between the two. And it's not a lot. It might be a few points difference. But it is better to miss a low payment than a high payment if you have to pay anything 30 days late, although you shouldn't pay anything 30 days late. Pay off collections in escrow, not before. I already said that. Just like if the lender requires that a collection or a charge-off get paid because it's a cash-out refi, tell them, say, well, can we get the demand letters and have it paid through escrow? That way the loan closes, and if the credit score does tank, it's going to tank a couple weeks later, and no harm, no foul. The borrower still got approved. Now, how long did delinquency stay on the credit report? Does anybody want to guess what stays on the longest? I heard liens, collections, bankruptcies. Well, there's a few right answers. Actually, it's the right answer, depending on the situation, could be judgment, lien, or bankruptcy. Bankruptcies stay for 10 years from the filing date for Chapter 7 and 11. Okay? Anytime you file but don't have a bankruptcy fully discharged, it's still going to stay for 7 years that you filed. So don't think if somebody doesn't go through all the way that they're going to get off the hook. No, it stays for 7 years. But if it gets fully discharged, Chapter 7 and 11 stays for 10 years, while Chapter 13, no matter what, stays for 7. Now, liens, like the reason I say the answer is not one answer, a bankruptcy hypothetically can stay longer than a lien. But a lien hypothetically can stay longer than a bankruptcy if the person doesn't pay it. A lien can stay the longest of all because it stays for 7 years from the time it's satisfied or released. So if somebody gets a tax lien and they pay it 12 years later, it's going to come off at year 19. Even though in practice, usually at 15 years they drop off, but the law allows them to keep it there for 19. But it's all over the board, so don't assume the 15, although it seems to be the way it happens. Now, judgments can stay for 7 years or the statute of limitations. Now, in some states, like California, the statute of limitations is, I think, like 9 years and 10 months or something before the judgment has to be renewed. So hypothetically, it can stay for 9 years, 10 months, and then if the judgment gets renewed, then it can stay for another 9 years and 10 months, whatever it is. Now, but in theory, it falls off after 7 years. I'm just telling you what they're allowed to do, but in reality, it usually falls off after 7 years. And I covered those three. Inquiries, they'll stay for 2 years, but they only hurt the credit score for a year. But you'll see them for up to 2 years in certain reports. Tri-merge companies usually don't report them that long, but you may, depending on the format. And then late payments, of course, 7 years from the time they're paid late. Now, charge-offs, they stay for 7.5 years from the first late payment that led to the charge-off. That's how long they're allowed to keep them there. But I usually see them fall off after 7 years and a month. Like they'll fall off at that time, but sometimes they don't. But if you have to go after them and pull legal cards on the credit bureaus, it's going to be 7.5 years from the first late payment that led to the charge-off is when legally they have to take it off according to the Fair Credit Reporting Act. Now, revolving debt ratio, folks, 30% of the score, and this is where you can pick up a lot of points. So it's this is what can be utilized the best for your borrowers. This is where you can advise them the most and really give value to them. Share your debt among many cards if you have to have debt. I always tell people pay it to zero, but if you can't afford to, at least spread it evenly. So if you have 3 credit cards, and let's say that 2 of them are $10,000 cards, and 1 is a $4,000 card limit, and you owe a total of $8,000 in debt, and you have it all on 1 credit card with a $10,000 limit, well, the thing you do is you get your 3 credit cards, 10, 10, and 4, that's $24,000, and you divide the total debt owed into the $24,000 to get your debt ratio. So 8 divided into 24 is 33%. So you're better off having 33% of the limit owed on each of those 3 cards rather than having the whole $8,000 on one and the other 2 at 0. You can get like a 5 to 15 point jump just by moving it around evenly. The credit score treats it more favorably. Now, whenever you're not getting a loan or your borrower's not getting a loan, I suggest taking advantage of the 0% offers or wherever the money's best with the credit card, like move it around, keep it on 1 credit card. Don't follow this advice every single day. This is like meant to be, hey, it's mortgage time. We got to get the credit score where it's at. Because when you're not getting a mortgage or an auto loan, it really makes sense to keep credit cards on the lowest interest rate that you can because you'll save money. Now, use the credit cards every 6 months. If you don't use the credit card every 6 months, it becomes inactive, and the credit score will ignore it for certain things that it looks at. You won't get the average age benefit. You won't get the low debt ratio benefit and the positive payment history benefit as much so as you would if it were an active account. Reason being, a lot of people have credit cards that they don't even know they have. Like they lost them a while ago, but they never canceled them. So whenever the account is inactive and it hasn't been used in 6 months, a lot of the time if that person knew that they had that credit available, they may have went out there and used it and charged it up. So they don't respect you as much. It's almost like, if somebody, it's like a kid in a candy store. If you have a kid in a candy store and he sees every candy bar there and doesn't touch all of them, then he's going to be considered to have much more self-restraint, and the parent would say, good, you actually held back. But if the candy bars were in a closet and the kid didn't know about it, you can't praise him for restraint because he didn't have a chance to see if he was going to screw up. That's sort of how the inactive credit card thing works. So use it every 6 months to get gas, and then wait for the bill to come in, pay it off, it'll keep it active. Now, the never close credit cards, ever close credit cards. It'll kill your debt ratio and reduce the average age of the credit file. If you have those same 3 credit cards, you owe $8,000 on the one, and the other 2 you owe 0. If you close the 2 you owe 0 on, before you closed it, you were at 33% debt ratio, correct? Okay. You close those 2, instantly you're at 80% of your debt ratio because you have 1 credit card that you owe $8,000 on, and you only have $2,000 more to spend, and your debt ratio is 80%. So never close credit cards because you'll kill yourself in that area. And also, if you close a 12-year-old credit card, it's not going to have its 13th birthday, and your average age of the credit file is going to suffer too. So always keep them open. Even if you don't like the credit card, then don't use it. If it's a bad interest rate, if you're paying a yearly fee, that could be argued that if you want to save $80 for whatever reason, I still suggest try to switch to a different card. Usually credit card companies, like if you have an airline card you don't use, Chase or Citibank or whoever, they have another card that you can keep the same account number and keep that account open, but it's a free account that doesn't have the airline miles or something else. So don't assume you have to close the card just because you're paying money. Pay off before the closing date. Most credit card companies will send, whenever they send you your statement that you owe X, let's say it's $9,200, that's when they report to the credit bureau that your balance is $9,200. So even though you pay it off, you still for 30 days are going to have $9,200 showing on the credit report, which means your credit score is going to be lower as a result, because the credit score looks at what's at the credit report. It doesn't go to Citibank and knock on their door for the figure, okay? Now, if you have a borrower that's like barely making it, but they pay their credit cards off or they're on the cusp, tell them to call their credit card company up, find out when the statement closing date is, call them 6 days prior, and drop a check in the mail once they find out what the balance is, to make sure that when it closes 6 days later, it's going to close it close to zero, because their payment will post by then. So then they have a zero showing for the whole month, and then on day 2, after the statement closes, they can go and max it out and still have a zero showing the rest of the month, okay? To show you how this could really be utilized, I had a friend one time, and I said, I want to try something. I said, I know you're about $100,000 in credit card debt. I said, I want you to add me on all your credit cards as being able to speak on your behalf. And I called all the credit card companies up, and I found out when his statement closing dates were. He didn't have any money to pay them down, but I moved everything around according to the closing date. So let's say Citibank closed on the 15th. I made sure that Citibank was paid to zero on the 14th. Then on the 16th, I maxed Citibank out to pay Chase off to close on the 22nd. Well, to make a long story short, without spending a dime, I had his credit report for 7 days straight showing a zero balance for credit card for his credit cards. His credit score went through the roof. It went up about 70 points, but he really still owed the $100,000. But I knew whenever it was going to get reported, so you're able to like tweak that a little bit. I don't suggest you go that far for your clients. It's a little bit much, but you know, unless they're willing to pay you for it. Yeah. No, I'd keep them. Personally, I have 18, and I still have a 780 credit score. So it's but the beauty is with credit cards, they have 0% offers, 1.9. They have all these great deals all the time. I'd rather have the availability of that, because I'll tell you what I do with this is a quick thing about a HELOC. HELOCs you got to be careful with, because the HELOC is a big credit card as far as the credit score is concerned. So if you're going to get a HELOC, make sure you get as much as you can, and then even if you only need 25 grand, like try to get the borrower to get a $100,000 HELOC if they qualify, and tell them only to borrow 25 grand of it, so that way your ratio stays low. But the good thing about a HELOC is it's a big credit card that you can pay from. You can like pay down, borrow from, pay down, borrow from. So with credit cards, the thing I do is since I have enough credit available, I call the credit card companies. Citibank, what do you got? What, 0.9 for the next 8 months? Great. Give me 30 grand, send it over here. Boom, pay down the HELOC. Do it with all the credit card companies. Some are at 0, some are at 3.9, some are at 2.9, whatever. But my HELOC is at 7.5%, okay? It's a $300,000 HELOC at 7.5%, and since I'm getting a tax write-off for the interest, let's say I'm in the 33% tax bracket, my true cost of money is what, 5%, right? Anything I can hold money at below 5%, I'm making the money on. So my average, I got the HELOC paid down to 0, and with all my credit cards, the average I was paying in interest on the 300 grand I used to pay down the HELOC was 1.7%. I effectively made 3.3% on my money for the year, which is 10 grand. Okay, so I saved 10 grand by utilizing my credit cards with the HELOC. Now, the side benefit of that is all the credit card companies look at me like sending these huge amounts of money back and forth. So what do? They keep upping my limits because they think I can handle it, So you can help yourself in many ways there. Yeah.
How is it that you score that you can know the client's going to get a mortgage in weeks or months?
It does. Opening a new account is bad for the first month because it says too new to rate. It's also bad because it reduces the average age of the credit file. But, I mean, for mortgages, for the mix of credit, it's good to have one mortgage. I had a client that had a 700 credit score, did not have a mortgage, got an $800,000 maxed out WAMU mortgage, and their credit score in the first month dipped 5 points to 695. Then once they paid the account on time for the first payment, it updated as paid as agreed. Then it gained the 5 points it lost plus another 12. They were to 712 because they helped themselves out in the mix area. But opening a credit card or something like that, I wouldn't do it right before. It's better to do that. Like the best thing you can do right before is an authorized user. If you add somebody as an authorized user or they add you, whenever the primary opened up the credit card, it gets reported as the opening date on your credit report. So you can have an 18-year-old kid and the parent has a 30-year-old Citibank they add the kid to, and the 18-year-old kid has a 30-year-old credit card, and the credit score goes up big time. Because the credit score does not look at age of the person. It doesn't look at the birth date. There's a lot of things it doesn't look at. It also doesn't look at the column that designates primary, joint, or authorized user. So if it sees an account reporting, it assumes it's that person's, and it scores it accordingly.
Hey, Ed?
Okay. Yeah.
If we could try to channel all the questions to the end.
Yeah, definitely.
And then also, if you wouldn't mind, I love this one story. Your friend who had a 0 credit score?
Oh, okay. I had a friend, his brother came over from France, and he's like, oh, he has a 0 credit score. What can we do? Now, building credit takes time. It's like, I don't have any magic answers to how to build credit other than get added as an authorized user and get like a small first Premier card to start off and use it, ask for a credit limit increase at 6 months, maybe apply for a Capital One at 6 months. It takes time. It doesn't happen overnight. But he had a 0 credit score, and to help him out, I added him to the first credit card I got in college, which was a Citibank. So my Citibank card was like 16 years old. It had like a $25,000 limit and a 0 balance, okay? I added him. The next month it reported on his credit report. His 0 was a 742. And all it had was one credit card that he was an authorized user on. So you see the power of it. But I really think it's going to go away eventually. Knowing what I know about software, it's not that much harder for Fair Isaac to build something into their software where they look at the field that designates authorized user, primary, or joint, and if they see authorized user, ignore the account completely. But up until today, it's still working. So let's hope it stays that way. Now, the credit limit, folks, ask for credit limit increases as much as possible. It helps your credit score. Some lenders don't like when somebody has too much credit available, but it's not going to kill whether they get approved or not. That's usually when you're applying for a credit card. They'll say too much revolving credit available already, so that rumor spreads, and everybody thinks having too much credit is a bad thing. It's not a bad thing for the credit score, folks. It's great for the credit score. A lender's other decisions and factors they use on top of the credit score to approve somebody may affect, but not the credit score. The more the merrier. If you can get your credit cards up to $1 million in limits, which is like probably very hard to do, you're going to be gold. Even carrying $100,000 in credit card debt, it's going to be no effect on you. Maintain your balances below 10%. There's thresholds. Get below 50 at a minimum. Get below 30 if you can afford to. Get below 10 if you can afford to do that. But I tell people as close to 0 as possible. I had a client one time, had $17,000 in credit card debt, $30,000 in limits. That's about close to 60% debt ratio. Said they were getting a loan. They had a 680 credit score. They wanted to get a 720 product. I said, can you borrow money from your parents to pay the credit cards off, and then after the loan closes, you can do a cash advance and pay them back. She's like, okay, yeah, I can do that. She did that, paid the credit cards down to 0. We got it updated. Her 680 went to a 780. Okay, now that's extreme. It usually doesn't jump 100 points, but it just shows you the power of having low credit card debt. Don't close them. Now, the spouse. Keep credit separate from your spouse, folks. This is the best advice I can give you today. Not because you're going to get divorced, which you probably are. But I'm telling you, there's no reason to have joint credit cards. All it does is shoot you in the foot. I had clients that wanted to be able to get, they had both had 680 credit scores, no late payments, so I couldn't help them get negatives removed to be able to get them approved. But I looked and I saw that they had separate credit cards. Everything was separate. They both had about $50,000, $60,000 in limits, and they both had close to $30,000 in debt. So I said to spouse A and spouse B, do you guys trust each other? Yes. Okay, well, I suggest that spouse A do balance transfers or cash advances, whatever, pay down spouse B's credit cards to 0, and then spouse B, you apply for the loan only in your name, and your credit score is going to be over 720, looking at what I see right here. And then at the closing, you can do a quick claim deed and put spouse A back on. You both still hold title, but the note is being carried by one spouse. They did what I said. Their 670, 680, spouse A went down to like a 620 because they were maxed. Spouse B went up to like a 730. Okay, but now, if spouse A and spouse B had joint credit cards, no matter where you move the money to, it's going to show in both reports. You can't get away from it. So never get joint credit cards. It makes 0 sense, and it's not going to help you out. I don't really suggest putting 2 people on a mortgage unless you have to for income reasons if they're going full doc. If it's a credit scoring driven loan and you can get one person approved, then why put 2 people on the loan? What benefit do you get from that? Unless you need to do that to get them approved. It's better to have the other person have no mortgages and maybe be able to buy a second vacation home at a first-time buyer program or whatever that they wouldn't have the option to do if they were on the other loan. Now, business credit. Utilize business credit. Most business credit cards, even though you sign personally, they don't report to your personal credit report. And if they don't report to your personal credit report, you're not being scored. If you have business credit cards and you have a lot of credit card debt personally, you can do a balance transfer from your business credit cards, pay down your personal credit cards, your credit score goes through the roof, your business credit cards are maxed over here, but who cares if your business credit cards are maxed because it's not being looked at for the score. But if you don't have business credit cards, you don't have that option. So if you already have credit, try to build your business credit alongside to have it so you can move it around. And folks, you can buy things on your personal credit cards that are business related. You can buy things on your business credit cards that are personal related. And it's not that you can't take the tax write-off. You have to just have good accounting. If you spent $100,000 on your business credit card this year and 50 of it was for personal reasons, then you're only using the expenses for the 50 that wasn't. It doesn't mean you can't use it for something else. You just have to keep the accounting separate and pay attention. That's all. Now, the average age of the credit file, folks, 15% of the credit score, and I'm going to blow through these slides because these are pretty self-explanatory. The longer the history, the better. Hold on to old credit cards. You want to keep them aging. Piggyback off mom to get history. It's the same thing as authorized user. And then now the mix of credit, like I said before, 3 to 5 revolving credit cards. You want to have 1 auto and 1 mortgage loan also to maximize that mix. If you start getting more than 2, as soon as you get over 2 mortgages, when you have 3, 4, 5, 6 mortgages, you're going to start hurting yourself in that area. Just like when you get too many credit cards, you'll start hurting yourself. But I think it's better to have the credit cards there and take a few points on the credit score, take a hit like that, to have the freedom and flexibility of being able to get those 0% and 2.9 offers when they come along. And they come along often when you have good credit. You just got to call them up and ask. Equity lines of credit, I already spoke about those. Big credit card. Now, in the past, when I've told people, hey, over a certain amount, an equity line of credit, home equity line of credit, is treated like a mortgage-related loan. And I usually don't say something unless I saw it with my own eyes, but somebody high up at Fair Isaac, they told me it like they were telling me the holy grail, like where a treasure chest was, like it's super inside scoop. So I believe them. I've proven it wrong several times. A $300,000 HELOC maxed is a $300,000 credit card maxed. The score will tank. I have a HELOC because I like to be, I can still keep my credit score over 720 because I have enough revolving credit available with other things that it didn't hit me that bad. But be careful, use a HELOC and approach it cautiously because sometimes it can hurt, but there are ways you can use it to help you out a lot. Inquiries, 10% of the credit score. It only affects the credit score for 1 year, even though it stays for 2. And it costs the score between 0 and 50 points, depending on what other things are going on in the credit. Sometimes a person with a very thin file, 1 inquiry will get them to switch to a different set of scorecards, and it'll screw up ratings of, maybe their late payment wasn't being treated that bad on this scorecard, but on this scorecard it is. So it can screw things up, and you can have a 50-point hit. But in reality, it's about 5 points an inquiry, 9 times out of 10. Okay, it's going to be around 5 points. Scores only reduced for the first 10 inquiries. So only the first 10 inquiries in the past year reduced the score. But here's where the confusion comes in. Auto and mortgage inquiries made within a 45-day period are treated as 1 for scoring purposes. So if you see that somebody has 12 inquiries in the last year, don't assume that you're number 13 until you do the math. Go back and see if the first 12 inquiries were, maybe 10 of them were grouped within 45 days from different car dealers. That means that they really only have 3 inquiries, and yours is number 4, and you will hurt them. But the beauty is, your inquiry, and same with auto inquiries, they have a 30-day buffer period. So if you pull somebody's credit today, and they have a 702, don't worry about the lender pulling it in 2 weeks, and it's going to be lower because your inquiry is not going to take effect for 30 days from the time it's made. Okay? Many inquiries, folks, they don't count. Personal, pull your own credit report online. Promotional and job-related inquiries, insurance and account review inquiries, they don't count. So they don't hurt the credit score, so don't freak out when you see them on there. Now, the credit scoring components, folks, I'll wrap it up. Past delinquencies, 35%. Debt ratio, not credit card balances, 30%. 15% average age of the credit file, 10% mix of credit, and then the final 10% are inquiries.